You're watching Masters in Trading Live with Jonathan Rose.
Hey everybody, it's Jonathan Rose and welcome to Masters in Trading Live. It's actually not live. I'm filming this Saturday. It's a lovely day in Chicago. We don't get to say that very much except a few, maybe 3 months or 4 months out of the year. But this week, I'm going to be on vacation. I'm back Friday, but throughout the week, I put together some very valuable educational content that I want you to go through. It's really important. It shares how to use the tools that are shared for free at the Chicago Mercantile Exchange. They're called the CVOL tools, and I use them all the time to find really great trades. So check out this week. We'll have Masters in Trading Live every single day, 11 o'clock Eastern time, like we normally do. JR, I'm going to be on vacation. I'm taking my 18-year-old. We're going to Philly. We're going to go see some museums and go see the Eagles training camp. And he's making me go to see some music that I'm not really sure who they are, but I'm sure it's going to be a blast. I got 4 topics. DEF CON. What's going on? It's significant. We'll talk about volatility. QQQ. I have a chart that shows that QQQ is very expensive, even after this significant move that we just had in this past week. And then finally, I'm going to give you guys a trade of the day, and it's going to be an entire sector. Buy uranium. Let's go over the charts. I'll show you exactly what I got. Okay. DEF CON 1 through 5. 1 is nuclear attack. I think 5 is everyday life. I would say we're about 2. And my big concern right now, there's a monthly chart in the Qs going back to, quite a bit of data. Now these are just 3 and 4 standard deviation bands. Very sharp moves. Takes us outside of the bands, comes back inside of the bands. We haven't had a sell signal since 2022, and you can see how quickly the market came off. I always like to look how effective these were in the past. Pretty darn effective. Well, the one thing about charting is you always have to look in different time frames. So let's look at a week. NASDAQ, obviously super strong over the last couple of years. Take a sip of water, and then let me go to a daily. And the daily actually gives you a buy signal. But remember, even with a buy signal, which I wouldn't be surprised if the market bounces, still extremely weak. And I'm going to show you exactly what numbers that we're looking for to confirm that extreme weakness. For one, keep going with the slides too. VIX, we'll come back to you. Tom T. He's a member of Masters in Trading and an active member in our Discord community. Check him out on Twitter. He actually took a Python course and built this, which congrats, Tom. It's very, very, very cool you're able to do that. And he posted this, and this is the VIX 1 day, 9 day. We talk about this often. For those who continuously watch Masters in Trading Live, thank you. That's why we're going to be gifting this week of free educational content. But you'll know that we talk about VIX term structure all the time. This is a measure of volatility over 1 day, a measure of volatility over 9 days. VIN near 20. So this is like 23 days. The VIX is 30 days, 37 days, 90 days, 6 months, and then 1 full year. So what's going on right now is this is a big inversion, or VIX curve kind of getting kinky. Kinky is all this weird movement. What it seems to me, I think we're just coming into election risk. That's what I think this is. I think we're just walking into election risk that we know is coming. I know red's not the best color, but let me walk you through this one. Make it a little bit easier to see. With another red. But what am I looking at here? This is the difference between the VIX and the VIX 1 year. And so right now, we haven't seen the difference between these two at negative 0.96 since early 2023. So this is really a significant move that we're seeing in the volatility indices. And if I bring up the VIX right here, and the VIX, you could trade options on the VIX, and you could see market makers are pretty good at valuing the VIX. Over the last 3 years, the VIX has traded inside its expected move 80.56% of the time. And if you look at this VIX spike right now, and the VIX is just a measure of uncertainty. Again, we go back to that time period in 2023, where it gets out and does come right back in. I would not be surprised if we do come right back in, rally a little bit, but long term, we are turning bearish for sure. What are the charts we got? And then finally, the NASDAQ that we already went over. So yes, this week, I'm going to be out 11 o'clock a.m. Eastern time every day. We're going to have some awesome education coming your way. So please tune in for everybody in All Access. You guys hang around. I got a trade that I think you guys are going to like for the week. Oh, no, wait, we're going to buy uranium. You guys don't go anywhere. Excuse me. We got more to cover. Don't you go anywhere. Back to the screen. I thought I missed something. All right. So uranium. When we talk about uranium, you have a couple of different options, not to be too punny. CCJ, uranium company, outside of its expected move. All of these closes within 77% of the time, but also long-term investing at uranium at these levels is a prudent play. So CCJ is something to consider. For use is another one to consider. These are very volatile, but buying them on pullbacks works. Closes within 83% of the time. So for use. DNN is another, Denison Mines. Okay, the whole industry pulled back. We like to say when the market starts to move, everything is a beta of 1. What does that mean? When the market starts to move, the beta of a stock is the overall systematic risk. So sometimes the moves that drag down industries have more to do with the beta of the system than uranium. I don't like looking for tech stocks to bottom fish until things settle down, but right now, URA is another one. Not as volatile as some of these, 77% of the time. If I pull up, let's talk CCJ. CCJ will be the trade we'll put in our promotional portfolio, which you'll find underneath. I want a little bit of time. I think September is plenty. September, I like buying to open the SEP 40 strike for 210. Now, this trade will be held till expiration. If you ask how long we're going to stay in this trade, I'm going to say we're going to stay it. Right now, the answer is 48 days. So we're going to stay in this trade for 48 days or until we could take out a big fat profit. Now, the trade is risking $210 per contract. The way that we trade this is we do things in tranches. So a tranche, we would do this in 3 tranches. So a trader might buy 2 to open a position. That's going to be $420 of risk. If CCJ continues to go against, we're willing to risk more. So I like buying 2, $420 of risk, but the plan is that we're willing to risk up to $1,000 in this example if it goes against us. If it doesn't, if it starts moving our way like we think it does, we'll share position management tips like we do. But we're in this for 48 days while we're risking principal. Whatever we put into play, whatever we put into the market, there's no stop. That money is at risk. I am really glad that I came back and talked about uranium before we get into the all access earnings trade. Have a great week. Thanks for watching.